Welcome to Tech Lab by Sid. In this video, we are going to discuss about SAP FI R2R Cycle. Here are the common abbreviations related to the topic. Feel free to pause the video and take a moment to read through them if needed. What is the Record to Report cycle? The Record to Report cycle is the process that covers everything from recording financial transactions to generating financial reports. Think of it as a way to make sure the company's financial data is accurate and complete, and that it's used to create reports that help managers, investors, and regulators understand how the business is doing. R2R cycle is important as it tracks company performance to determine profitability, ensures accurate financial reporting for audits, and supports compliance with accounting rules and regulations. SAP provides automated tools and modules for financial transactions, reporting, and closing processes. SAP S/4HANA streamlines the R2R cycle with real-time financial data and improved data integration. Let's take a quick overview of FI or Financial Accounting module. In this module, all the financial data is entered, stored, and processed. It helps keep track of the company's money, what it owes, what is owed to it, and its overall financial position. This involves several key components. General ledger, which records all financial transactions. Accounts payable, for managing vendor invoices and payments. Accounts receivable, for handling customer invoices and receipts. Asset accounting, for tracking the life cycle of fixed assets. And bank accounting, for overseeing cash transactions, bank statements, and reconciliations. The R2R cycle in SAP encompasses several key steps to ensure accurate financial management and reporting, as shown in the flow diagram. First, data entry involves recording financial transactions, such as journal entries, invoices, and bank statements into SAP to ensure precise data capture. During the period end closing, SAP makes necessary adjustments, accruals, and reconciliations to finalize financial records for the period. Next, financial consolidation takes place, where data from multiple subsidiaries or entities is consolidated into group-level financial statements, ensuring consistency and eliminating intercompany transactions. SAP then generates financial reports, including the balance sheet, profit and loss statement, and cash flow, providing real-time and accurate reporting for stakeholders. The system also supports audit and compliance, maintaining an audit trail and internal controls to ensure regulatory adherence and financial transparency. Finally, financial analysis is conducted using key ratios and SAP reporting tools to assess profitability, liquidity, and overall business performance. Let's discuss each step of the R2R cycle, one by one. The first step is data entry, where all financial transactions are logged as they occur within the organization. This involves entering data into the SAP system, ensuring that purchases, sales, payments, and other financial events are accurately reflected. This stage is critical as it lays the foundation for the entire R2R process. Key sub-processes within data entry include journal entries, where accounting transactions are captured through general ledger accounts, and cost centers, invoices, which involve recording customer and vendor invoices, and bank statements, where bank data is imported and reconciled. FI module plays a central role in managing these transactions, ensuring each entry is recorded accurately for proper financial reporting. The next step is period end closing, a crucial step in the financial cycle, carried out at the end of each accounting period, whether monthly, quarterly, or annually. Its purpose is to ensure that all financial data is accurate, reconciled, and prepared for reporting. This stage includes several key sub-processes, such as month-end, quarter-end, or year-end closing, where the books are closed and all financial transactions are verified and reconciled. Accruals and deferrals are also addressed, making adjustments to ensure income and expenses are recorded in the correct periods. Reconciliation involves balancing the general ledger accounts to confirm that all transactions have been accurately posted. In SAP, tools like F.01 for financial statements, F.19 for GL reconciliation, and F.14 for open item management help streamline the process, ensuring the integrity of financial data during period-end closing. This is followed by financial consolidation, a critical step for organizations with multiple subsidiaries or business units, where the goal is to combine financial data from these entities into a unified set of consolidated financial statements. SAP offers powerful tools to streamline this process, particularly when dealing with multi-entity businesses. One key aspect is consolidating data from subsidiaries, where financial data from different divisions or subsidiaries is brought together. During this process, intercompany eliminations are necessary, as transactions between subsidiaries, such as intercompany sales, must be removed to prevent double counting and ensure the consolidated financial statements accurately reflect only external transactions. SAP facilitates this through intercompany reconciliation tools. A key tool in this process is SAP BPC, or Business Planning and Consolidation, which automates consolidation, integrates data from various entities, and ensures compliance with global financial standards like IFRS and GAAP. Additionally, SAP BPC supports financial reporting, budgeting, and forecasting, making it an essential resource for effective financial consolidation. Next step is reporting, a key step in the financial process, where financial data is presented to stakeholders through various financial statements, such as the balance sheet, profit and loss statement, and cash flow statement. SAP offers powerful reporting tools that enable businesses to generate accurate, real-time reports for both internal and external stakeholders. These reports include internal financial reports, which are used for management and decision-making purposes, and external financial reports, which are required by regulatory bodies, investors, and other external parties. SAP provides several advanced reporting tools, including SAP Fiori, SAP BW, or Business Warehouse, and SAP S/4HANA Finance, to help create customized and detailed financial reports. Additionally, standard reports like F.01 are used for generating comprehensive financial statements, while S_ALR is employed for generating reports on balance sheet and profit and loss accounts. These tools ensure that the reporting process is streamlined, accurate, and aligned with business needs. Next, audit and compliance is a crucial stage that ensures financial records meet the necessary accounting standards and regulatory requirements, while also supporting audit processes by maintaining a clear audit trail of all financial transactions. SAP plays a key role in ensuring regulatory compliance with both local and international standards, such as IFRS or International Financial Reporting Standards and GAAP or Generally Accepted Accounting Principles. This allows organizations to align their financial reports with global accounting practices and meet regulatory obligations. Additionally, SAP provides a robust audit trail and internal controls by automatically recording every change or posting made in the system. This creates a transparent, traceable record that is essential for auditors, allowing them to track the origin of financial data, verify its accuracy, and ensure compliance with regulatory standards. Finally, financial analysis is a vital step in assessing the financial health of an organization using financial data to evaluate key aspects such as performance, profitability, and liquidity. This process involves calculating financial ratios like return on assets, the current ratio, and net profit margin, which provide insights into the company's profitability and liquidity. These ratios are essential for stakeholders to gauge the financial stability and efficiency of the business. SAP enhances financial analysis through powerful tools like SAP Analytics Cloud, which enables real-time reporting and financial forecasting. Additionally, SAP Analytics capabilities allow businesses to create interactive dashboards, providing management with real-time financial insights that support informed decision-making and help drive business strategy. The record-to-report cycle brings several key benefits that enhance financial operations within an organization. First, it ensures accuracy by using standardized processes and automation to precisely record and report financial transactions, minimizing errors. It also boosts efficiency, allowing organizations to close accounting periods faster and with fewer mistakes by automating data entry and report generation. Compliance is another major advantage, as SAP helps ensure adherence to financial regulations and provides a detailed audit trail of all transactions and changes. With real-time insights, decision-makers can access up-to-date financial data through integrated SAP tools, enabling timely analysis and strategic decisions. Finally, the R2R cycle ensures transparency by tracking all financial transactions in detail, which simplifies audits and regulatory checks and strengthens trust with stakeholders. In short, the R2R cycle streamlines processes, improves financial accuracy, and supports compliance, helping businesses make better-informed decisions and maintain strong financial management. Several SAP modules play a crucial role in the record-to-report process, each handling specific aspects of financial management. The FI module is at the core, managing financial transactions and generating fundamental reports such as the general ledger, accounts payable, and accounts receivable. The CO module focuses on tracking internal costs and performance, supporting cost allocation, cost centers, internal orders, and profitability analysis. MM integrates with financial accounting to manage procurement, inventory, and vendor transactions, ensuring accurate invoicing and financial records. The SD module handles customer invoicing and revenue recognition, linking sales activities to financial reporting. Treasury manages cash and liquidity, working alongside financial accounting to oversee payments, bank accounts, and cash flow. Lastly, BPC supports financial consolidation, planning, and group reporting, enabling businesses to integrate financial data from multiple entities for accurate financial analysis and decision-making. Each of these modules contributes to a seamless R2R process, ensuring financial integrity and transparency across the organization. The record-to-report cycle in SAP ECC and SAP S/4HANA differs significantly in terms of performance and efficiency. In ECC, transactions are recorded across multiple tables in various modules like FI, CO, and A2A, while S/4HANA simplifies this with the Universal Journal, that is, ACDOCA, consolidating data across financial and controlling modules. During period-end close, ECC requires several manual steps for reconciliations and adjustments, whereas S/4HANA streamlines this process with real-time processing and the Universal Journal, reducing manual work. When it comes to financial reporting, ECC relies on external tools like SAP BI or BW for advanced analytics, but S4HANA offers embedded real-time analytics and dynamic reporting through Fiori apps, eliminating the need for separate BI tools. The data model in ECC uses separate tables for different accounting objects, while S4HANA consolidates everything into a single universal journal, simplifying data management. Lastly, S4HANA provides a modern, user-friendly interface through SAP Fiori, in contrast to the traditional SAP GUI in ECC. Overall, S4HANA enhances the R2R cycle with real-time processing, integrated reporting, and a more streamlined data model, offering greater efficiency and better insights for decision-making. In conclusion, the record-to-report cycle in SAP is a vital end-to-end financial process that ensures accurate transaction recording, timely period-end closing, effective financial consolidation, comprehensive reporting, and compliance with regulatory standards. Each stage, ranging from data entry and period-end closing to consolidation, reporting, audit and compliance, and financial analysis, works seamlessly to deliver real-time, accurate financial data. This empowers businesses to make informed decisions and drive strategic planning. By utilizing SAP integrated modules and tools, organizations can streamline their financial operations, minimize errors, enhance transparency, and maintain full compliance with accounting standards, ultimately improving efficiency and financial insight. Thanks for watching the video. Be sure to explore our channel for more content like this.